Hi, in this video you will learn the key principle of diversification and what do some of the best investors in the world think about it. Let's start with the latter part.
We think diversification, as practiced generally, makes very little sense for anyone that knows what they're doing. It's a confession, in our view, that you don't really understand the businesses that you own. On a personal portfolio basis, I own one stock, but it's a business I know. Three wonderful businesses, more than you need in this life to do very well.
All that asset management, diversification, that's for idiots.
Diversification is a big mistake. I call it diversification. You buy this thing that might balance this other thing and they both go down. So I don't believe in diversification at all. I would own one stock.
The most important principle, holy grail of investing, that's about diversification. What it means is if you can get 10 or 15 good uncorrelated investments, you can reduce your risk by up to 80% without reducing your return. Risk reduction is really key. It's to know how to diversify well in the area of 10 or 15 investments, because making a fortune is not just a matter of the upside. It eliminates or reduces the downside so you continue to play the game. A lot of people think that the way you make a lot of money is to come up with the best single or few bets. That's wrong. That approach to the game will knock you out of the game. Keep in mind that what you don't know is greater than what you do know. That's the most important principle.
Diversification is for idiots. That's what you would hear say Warren Buffett, Charlie Munger, Mark Cuban, or Peter Lynch. However, the legendary investor Ray Dalio would strongly disagree with that point. In fact, he would argue that diversification is the single most important principle when it comes to investing. So, why do these great minds cannot seemingly agree on such a simple concept? Well, let me try to explain. It has to do everything with the investment strategy. Warren Buffett and Charlie Munger from Berkshire Hathaway are managing hundreds of billions of dollars for their clients, and yet they do not shy away from a concentrated investment approach. By their words, they would ideally place 75 to 100% in a single stock, in a single company. They were even joking they would go above 100%, of course by using leverage. However, the fact that they are managing the capital that doesn't belong to them is the main reason why they do not go all in a single stock. If we take a look at the most updated version of Berkshire Hathaway portfolio as of first quarter 2023, we'll see that the biggest position they have is in Apple, and it amounts for more than 46% of the whole portfolio, which is a huge position given the amount of money that they manage. So it is safe to say that they put their money where their mouth is. Generally, diversification is a great way to protect your portfolio against your own ignorance. Usually, the more competent an investor is, the less diversification is required. Now, is that to say that Ray Dalio and his Bridgewater Associates, which for those of you who don't know is the biggest hedge fund in the world, is less competent than, let's say, Peter Lynch or Warren Buffett? Well, yes and no. It is important to understand that the investment approach of Ray Dalio is revolving around macroeconomic and political forecasting, based on which Bridgewater executes its trades. Therefore, they do not concern themselves too much with stock picking, whereas value investors such as Charlie Munger and Peter Lynch are basing their investment decisions purely on stock picking expertise. They would research all publicly available information and even go as far as to physically inspect the business they are purchasing, which is already more than 99% of investors are able to do. Thus, their knowledge is essentially on par with insider information, which results in great confidence and ability to withstand the stock market volatility. So this is the main reason why these investors disagree on the usefulness of diversification. Another view, however, is that the main principle behind the proper diversification makes it impossible for investors such as Warren Buffett to fully utilize its benefits. Let me explain. By increasing the number of assets in your portfolio, you are basically achieving two things. First, you are changing the expected return on your portfolio, and secondly, you are changing the risk of your portfolio. The most efficient way to diversify is to invest in the assets whose prices are not strongly correlated to each other. Let me explain this on a very simple example. Let us say that an investor A has 5 US stocks which are in the same sector and offer similar services. On the other hand, investor B has only 3 assets, and that is one American stock, gold, and emerging markets ETF. It could look something like that, where investor A has 5 communication services stocks in his portfolio, and investor B has shares of Apple, has some physical gold, and emerging markets ETF. So, even though portfolio A is spread across 5 individual companies, it is in fact less diversified than portfolio B. The thing is that portfolio A does not achieve an efficient risk reduction, and that is because the only thing that is being diversified there is a company-specific risk. Portfolio B, on the other hand, is much better diversified, even though it is invested in lower count of assets. Thanks to the fact that prices of those 3 different assets are weakly correlated, the portfolio B is able to diversify not only company-specific risk, but also geographic risk, political, cyclical, currency, and systematic risks. Therefore, even if it is true that portfolio A has higher expected return because US equity is historically the best performing asset class, the risk to reward ratio is much more attractive in case of portfolio B. And there you have it. The key principle to diversify your portfolio efficiently, in other words, to reduce your risks much more than you compress your expected returns, is to diversify it across assets whose prices are weakly correlated. This concept is well illustrated in the following chart from Ray Dalio's book Principles. He calls it the Holy Grail. On left vertical axis, you've got volatility of the portfolio, which approximates its risk, because usually the more volatile is your portfolio, the riskier it is. On the bottom horizontal axis, you've got the number of assets included in the portfolio. What this chart shows is that the more correlated are prices of the included assets, the less risk reduction is achieved with each additional asset. So, for example, if you had 5 assets in your portfolio whose prices are weakly correlated, let's say 20% correlation, you would achieve on average reward to risk ratio of 0.42. Whereas if you had 15 assets in your portfolio, which person that does not understand this concept would say diversifies your portfolio much better, and the prices of those assets are highly correlated, let's say 60% correlation, on average you would achieve reward to risk ratio of 0.31, which is worse than in the first case because you want to maximize this ratio. So indeed, this chart shows that in previous example, the portfolio B was much better diversified than portfolio A. Going back to our investors, the second reason, other than area of competence, why stock pickers such as Warren or Peter are not fans of diversification is because they invest only in one asset class, the US equities. There's only so much risk reduction that you can achieve by investing in a single asset class, as shown in our previous example. Whereas at Bridgewater Associates, they do not constrict themselves only to US equities. Therefore, from their point of view, diversification can be much more fruitful, and that is why it makes sense to them. Wrapping this all up, it is primarily less competent investors, which is most of the retail investors, and investors with large portfolios who need most to know how to diversify well. If your portfolio is small in size, the diversification is losing its meaning because your primary goal in such situation is to grow it. Hopefully, as your portfolio gets bigger in time, the need for diversification will increase because the more money you manage, the less risk you must undertake. That is a common sense. So although it might seem like a good idea to sell your house and YOLO in 3 or 4 stocks, the things get much more complicated with higher capital endowment.